Welcome back, friends. I'm down here at the river fishing. I got a new kayak that I'm getting to enjoy a little bit, even though it's a bright sunny day. But I wanted to take this opportunity to talk about total market funds. They're very popular. They have been for years. Matter of fact, the largest fund right now is a total market fund. It's Vanguard's VTI fund. For years, I used this fund as my primary diversification mechanism. However, last year, based on some research that I was doing on index funds, I've shifted away from exclusively using VTI for my diversified investments. Today, I'm going to explain why I made this change. For years, I had used Vanguard's Total Market Fund, VTI, for my diversified equity investments, thinking, oh, this gives me a good diversified portfolio across large and small cap, and it gives me something that a simple S&P fund wouldn't. I'm going to use VTI in this discussion a lot. That is partially because that's the fund that I use. It's also by far the largest fund in the marketplace with about $1.2 trillion under management. Now, this should in no way be considered as a slam on VTI or on Vanguard. I'm actually a huge fan of Vanguard funds. I continue to use them. This is just indicative of the market that we're operating in and why a total market fund is not providing me the value that I was looking for in terms of diversification. I had used VTI because I wanted to increase exposure to mid and small cap companies that were excluded from the S&P 500. However, what I was getting did not end up matching my expectations because of the makeup of the stock market and the way total market indices are structured. So let's take a closer look at VTI. VTI is positioned as a total market fund. It actually follows the CRSP US Total Market Index. Now, VTI holds approximately 3,700 stocks and has total assets of $1.2 trillion. I don't want you to miss the magnitude of this fund. This is enormous. If you were to randomly go on Yahoo Finance and click some of the companies that are on there, Vanguard is usually one of, if not the largest single institutional owner of most companies. And within that, VTI owns a pretty substantial piece. It's actually up to about 2.8% of essentially every publicly traded company. That is enormous. We're talking about 2.8% of companies like Apple and Facebook, the whole way down to your small and micro cap companies. Again, there are 3,700 US stocks in this total market fund. Now, on its face, this looks like good market exposure and diversification across large and small and mid-cap companies. Even Vanguard's website seems to imply that you can get all the US equity diversification that you need using this fund. But as with many things in life, the devil's in the details. So let's dig in and actually look at what does VTI hold. And this is what started me down this trail. VTI has 3,700 companies in the index. However, the top three companies, Apple, Microsoft, and Alphabet, which is Google's parent company, have about 12% of the index. That means if I was to invest $10,000 in VTI, $1,200 of that would be held in just three companies. Now, if we expand that three to the top five, which adds Amazon and Facebook, we're talking about 17% of the investments in VTI are going to five companies. Now, if we take it one step further and go to the top 10 holdings, we're up to over 22% of the fund assets are invested in just 10 companies. That is not exactly what I had in mind when I thought diversification. So exactly how much mid and small cap exposure am I getting in VTI? It turns out that 85% of VTI holdings are the largest 500 companies. Now, these are mostly overlap with the S&P 500. What's left is you end up with about 8% of your investment in mid cap and 6% in small cap. Remember, this is across 2,700 companies. So not exactly the investment outside of the S&P 500 that I was looking for. But I'm investing in over 3,700 companies, right? So I must be getting some diversification. Well, yes, but it's not quite as evenly distributed as you would think, and that's just because of the makeup of the stock market. So if we looked at some cutoffs in terms of how much is invested in each company within the total market fund, our 10th company, which we just kind of looked at, is just under 1% of the investments. If you move the whole way to the 100th company, you're still at 30 basis points, or 0.3% of your holdings are in that 100th company. If we now go the whole way down to the 500th company, we're talking about only 0.03%. That is very small. Now, if we looked at a $10,000 investment, the amount of dollars invested in that 500th company would be about $3. Not exactly a lot of money. And if we go the whole way to our 1,000th company, remember, there are 2,700 companies smaller than the 1,000th company. We are looking at only 1/100th of a percent. That is the equivalent of $1 out of $10,000 invested. So what about diversification across industry? Unfortunately, it doesn't look a whole lot better, which is a reflection of the companies that are invested. Tech makes up 25% of the index. Now, I would also note that Amazon is not considered a tech company. It's considered a consumer discretionary company. So that 25% tech does not include Amazon, which their profits are mostly derived from tech, not retail. So tech is 25%, consumer spending is over 20%, which includes both discretionary and staples, and real estate is only 3.5%. Now, it's hard to compare this to what our broad US economy looks like, but it would be hard pressed to say that tech is 25% of our, say, gross domestic product. I will say, in looking at some of the analysis, retail is only about 6 or 7%, and real estate is 16%. Other things such as financials actually don't line up terribly bad, nor does healthcare and utilities. So even looking at it from an industry diversification standpoint, we're not quite as broad-based as what I would like to see, perhaps in a portfolio, although there are some challenges in getting a good industry diversification, regardless of what we end up doing, apart from picking individual stocks. Now, is this to say that total market funds are bad? Well, no, there's no inherent issue with total market funds. I'm actually a pretty big proponent of them, but they're almost always market cap weighted, and thus the largest companies are going to get the largest amount of investment, and thus the limited diversification in these total market funds simply reflects the makeup of our current stock market, where much of the value is contained in West Coast companies that have very strong pricing power in many areas of their business. That's why they're so valuable, and they're leveraging that pricing power for profits, which translate into market value. So as someone who wanted broader diversification, what did I end up doing? Well, I still invest some of my funds in a total market, but I generally view a total market fund as largely indistinguishable from an S&P 500. I treat them almost as interchangeable. But what I have done is I've added to that. I've added value funds, mid-cap and small-cap funds. Value funds, now these are opposed to growth funds. These exclude some of our biggest culprits for this lack of diversification, such as Apple, Google, Amazon, Microsoft, and Facebook are all excluded from, say, VTV, which is Vanguard's total market value fund. Now, that gets me some of the way there. However, I still run into the big companies get severely outweighed, even in a value fund. So I also layer in a mid-cap fund, typically Vanguard's mid-cap, which is VO, and their small-cap fund, which is VB. Those 4 funds largely make up what I would call my diversified equity portfolio. Again, that's a total market or an S&P 500 fund, a value fund, mid-cap, and a small-cap fund. And I adjust my weightings depending on what I'm feeling for the market. This does not, of course, solve every problem, but it does reduce my exposure to just a couple of companies that are all in similar industries. It also allows me to scale my exposure to mid and small cap companies based on my feelings of the market at the time. So that kind of wraps up my thought process and my journey through total market index funds. Hopefully you found my experience and research regarding total market funds helpful. If so, give this video a thumbs up and make sure you subscribe to Accounting Outside to follow me as I explore the world of accounting and finance. Thanks for watching. Have a great day and God bless.